Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Firefly Neuroscience.
If you find our talks useful, please consider subscribe, like, and comment underneath. Because today we really need to get right into the mechanics of this one. The setup you are looking at here is incredibly rare.
Yeah, it's definitely not something you see every day.
Right. So imagine watching a stock that has just been absolutely battered by the market. We're talking about a brutal, grinding 12-month decline where the share price just bled out by like 47.7%.
Oh yeah. For an entire year, the charts look like a slow-motion capitulation.
Exactly. Traditional investors had essentially left this company for dead. And then, out of nowhere, March 2026 hits, and the stock reverses course with terrifying speed.
The velocity of that reversal is really what forces you to pay attention. It wasn't a gradual recovery where, a few value investors started picking up cheap shares.
No, not at all.
If you look at the month-to-date gain for March alone, you were looking at a 106.31% return, a move that completely shatters the existing technical resistance levels.
And it didn't just drift upward, right? It happened in two seismic bursts that completely caught the market off guard.
Yeah, the dates on those are crucial.
Right. So on March 4th, the stock popped 64.67% in a single trading session. And then 9 days later, on March 13th, it surged another 126.3%.
Which is just massive.
It is. You don't see those numbers without exceptionally high share turnover. We're talking millions of shares trading hands in a matter of hours. A 126% daily surge isn't retail day traders playing games. That is the sound of institutional algorithms and market makers aggressively repricing a company's entire narrative.
Absolutely. When you see turnover that high, coupled with those triple-digit percentage gains, it tells you that the market suddenly realized its fundamental valuation model was broken.
Right. The smart money woke up.
It's exactly. Institutional money, quantitative algorithms, and momentum traders all collided at once. They looked at the underlying reality of the business and realized they had, fundamentally mischaracterized what this company actually does.
Which brings us to the core question for you listening. What is Firefly Neuroscience actually doing that flipped the switch? Because if you just glance at their sector classification, you see a microcap biotech company.
Right, and you assume they are mixing compounds in a lab, hoping to pass a phase 1 drug trial.
Exactly. You assume it's just another binary biotech play.
But that assumption is exactly why the stock was mispriced for so long. To understand this company, you had to completely discard the traditional biotech framework. Firefly is, at its core, an artificial intelligence infrastructure play.
Wait, AI, not biotech.
Yeah, AI. They are building a foundation model of the human brain. And to do that, they rely on two specific types of data, EEG and ERP.
Okay, let's break that down. EEG and ERP.
So EEG, or electroencephalogram, is a continuous recording of the electrical background noise in your brain. But ERP, which stands for event-related potentials, is much more specific.
Let's pause there because understanding the difference between those two data sets seems crucial to their whole technology stack.
It is. Think of it this way. An EEG is like placing a microphone outside a massive baseball stadium and recording the general roar of the crowd.
Okay, so just the ambient noise.
Right. It tells you if the crowd is awake, asleep, or agitated. An ERP is entirely different. An ERP is what happens when you introduce a specific stimulus like flashing a light or playing a sound, and you measure the exact millisecond-specific electrical spike in the brain's reaction.
Oh, wow. So it's much more targeted.
Exactly. It's like listening to the stadium, the precise fraction of a second the bat cracks against the baseball. By combining the general background noise of the EEG with the highly specific reaction data of the ERP, Firefly is training an AI to understand the baseline electrical blueprint of human neurology.
I see where this is going. It sounds functionally identical to how OpenAI trained ChatGPT.
Yes, that's exactly it.
But instead of scraping the internet for billions of text documents to teach a large language model how to generate sentences, Firefly is feeding raw electrical brainwaves into a model so it can learn how the human brain processes information.
That is the perfect framework to view this through. They are building a neurological large language model.
But I have to challenge the durability of that business model here, because in the AI sector, the algorithm is important, sure, but the training data is the actual gold.
Without a doubt.
So data is only valuable if you have a monopoly on it, or at least a massive head start. What stops a much larger tech giant or a massive healthcare conglomerate From looking at this, throwing $1 billion at their own engineering team, and just building a competing brainwave model.
It's a really logical assumption, but it actually misses the fundamental bottleneck in healthcare AI. You can have all the server farms in the world, but if you don't have the FDA-compliant clinical data, your algorithm is completely useless.
Because it's regulated healthcare data, not just public web pages.
Exactly. You cannot scrape medical-grade ERP data off the public internet. Firefly has spent years accumulating a proprietary dataset of over 191,000 brain scans.
191,000 scans is a staggering number when you consider the logistics involved in getting just one.
Right. Consider what it takes. You need the physical hardware, a controlled clinical environment, legally binding patient consent, strict regulatory compliance for medical privacy.
And then you have to actually normalize that messy biological data so a computer can read it.
Exactly. Gathering 191,000 highly structured, standardized brain scans creates an incredibly steep barrier to entry. Even with unlimited capital, a competitor would need years just to recruit the patients and run the clinics to match that database.
And processing that much raw biological data requires massive computing infrastructure. I mean, biological data isn't clean, it's incredibly noisy.
Which is why their technology infrastructure is the second half of that moat. They aren't running these models on standard commercial cloud servers.
What are they using?
They have a specific partnership utilizing NVIDIA L40S GPU acceleration. These specific graphics processing units are designed to handle massive, complex AI training workloads.
So you have a highly defensible combination, a proprietary dataset that takes years to replicate, paired with top-tier NVIDIA compute power to find the hidden patterns within that data.
Exactly. It's a very potent mix.
Having the NVIDIA compute power to map 190,000 brains is an incredible scientific feat. But as we focus on wealth building, we have to acknowledge that science projects don't inherently make money.
Sad but true.
Right. So let's look at what happened when they tried to take this technology out of the lab and put it into actual commercial clinics in 2025.
Well, the operational metrics for 2025 show a company in a state of hyper-expansion. They grew their partner clinic sites 20-fold, ending the year with 99 active locations deploying their technology.
Going from a handful of clinics to nearly 100 locations in a single year is massive physical traction.
It is. And the utilization of those sites grew even faster. Their total scan volumes experienced a 33-fold increase.
Wait, 33-fold?
Yeah. That translates to a 3,227% year-over-year jump, bringing them to over 10,800 clinical scans performed just in 2025.
A 3,227% increase in product volume is the kind of metric venture capitalists dream about. But this brings us to a glaring disconnect that we really have to unpack for anyone looking at the financial statements.
The financials are definitely a shock if you don't know what you're looking at.
Yeah, because despite expanding to 99 clinics and performing over 10,000 scans, their trailing 12-month revenue sits at a microscopic $108,000.
Yep.
And paired with that tiny revenue, they posted an operating loss of $10.1 million and a net loss of $10.5 million. I mean, a negative 9,300% operating margin isn't just a red flag. It's a blaring siren for traditional investors. How is this company not just lighting cash on fire?
That's exactly why you have to look past the current R&D burn rate and understand the mechanics of pre-profitability software scaling. Traditional fundamental analysis totally breaks down here.
Okay, so what should you be looking at?
The critical metric to evaluate isn't the trailing revenue or the operating loss. It is their gross margin, which currently sits at an absurd 331.6%.
I need you to explain that math. Because in traditional accounting, a gross margin over 100% is physically impossible. You can't make more profit on a single item than the revenue it generates.
In a traditional manufacturing business, you are absolutely right. But Firefly is utilizing a unique accounting structure based on deferred revenue from past strategic partnerships.
Oh, I see.
Yeah, they are recognizing previously deferred gains on their income statement without incurring new, immediate direct costs for those specific recognitions. But beyond that accounting quirk, the 331.6% figure signals something vital to investors. Their incremental cost to process a new scan is practically zero.
Because it operates like a pure software as a service model.
Precisely. It might cost them tens of millions of dollars to build the foundation model, secure the clinic partnerships, and run the NVIDIA infrastructure. But once that digital pipeline is built, the computational cost to run the 10,000th scan or the 100,000th scan is fractions of a penny.
Right.
Right now, they're absorbing all the heavy fixed costs of building the network. Once that infrastructure is fully deployed and they transition from free or subsidized pilot programs into full commercial billing, The revenue drops almost entirely to the bottom line.
So the heavy lifting is being done now, which explains the $10 million loss. But survival is still a mathematical reality. If they are burning over $10 million a year, how did they even survive to see this massive market breakout in March without going bankrupt?
The survival question was definitively answered on March 8th, just days before the massive stock surge. They executed a targeted capital raise that functions as a critical operational lifeline.
What were the terms?
They raised $2.25 million at $1.50 per unit. Crucially, the investors in that specific deal were granted an option to expand the financing up to $20.25 million.
Securing an option for $20 million completely changes the risk profile for a company of this size.
Oh, absolutely. It takes the immediate existential threat of bankruptcy off the table. It provides them with a secured 12 to 18 months of operational runway. Management can finally stop worrying about keeping the lights on and focus entirely on clinical execution.
That March 8th funding secures the runway, but simply avoiding bankruptcy does not cause a stock to jump 126% in a single trading session. The real fireworks happened on March 13th.
Yes. The March 13th catalyst was the moment their entire theoretical business model gained tangible clinical validation.
What did they announce?
Firefly announced they had successfully identified new, specific brainwave biomarkers for the differential diagnosis of ADHD subtypes.
Let's dig into the biology of that, because it highlights exactly why the market reacted so violently. Currently, diagnosing ADHD is a highly subjective process. A patient sits in a psychiatrist's office, fills out a behavioral questionnaire based on the DSM-5, and the doctor makes an observational judgment.
Right. It relies entirely on human interpretation, memory, and bias.
Exactly. So what did Firefly do?
Firefly's announcement proves they can bypass human subjectivity entirely. By running a patient's ERP data through their foundation model, the AI can look at specific electrical signatures, like the theta-to-beta wave ratios, or microsecond latency delays in the brain's executive functioning network.
So it actually sees the physical issue.
Yes, it literally sees the biological misfire that causes the attention deficit. It transforms mental health diagnostics from a subjective conversation into an objective, measurable biological data point.
It's the equivalent of inventing the X-ray, but for cognitive disorders.
Exactly. The market realized that the 191,000 brain scans and the NVIDIA processors actually resulted in a working clinical tool. The thesis was proven.
And if you look at the institutional money flow in the fourth quarter of 2025, just before this breakout, you see a fascinating divide in how Wall Street evaluated this exact data.
Oh, the rotation of the shareholder base leading up to this is a textbook example of algorithmic versus traditional trading.
Traditional wealth managers were terrified. You had major players like UBS Group and Advisory Services Network dumping tens of thousands of shares. They clearly looked at the $108,000 trailing revenue, saw the negative 9,300% operating margins, and dumped the stock to protect their portfolios.
Which makes sense under old models.
Right. But exactly as they were exiting, highly sophisticated quantitative trading firms were quietly accumulating shares. Jane Street Group added over 60,000 shares. Susquehanna International scooped up roughly 37,000 shares. Even BlackRock initiated a modest new position.
That rotation perfectly illustrates the information gap in the market. UBS and Advisory Services are traditional fundamental funds. They trade by looking in the rearview mirror at trailing revenue and EPS.
And by those historical metrics, the company looked fundamentally broken.
Yes, exactly. But Jane Street and Susquehanna are quants. They don't care about trailing revenue. They trade on forward-looking data velocity and probability models. They saw the 3,227% spike in underlying clinic scan volumes and recognized that an explosive clinical catalyst was mathematically imminent.
So the traditional managers sold the delayed revenue, while the quants aggressively bought the data advantage.
That's the perfect way to summarize it.
The quants bought the future, and the traditional managers sold the past. It's a brilliant setup, but, in wealth building, you have to rigorously protect your downside before you go chasing after institutional momentum.
Always. You can't just dive in blindly.
Right. You cannot just blindly follow a quantitative fund into a microcap stock without assessing the landmines. Let's outline the risk profile for you all, starting with the balance sheet.
The financial risks are immediate and severe, starting with their liquidity constraints. If you look at their current ratio, it sits at a precarious 0.53.
So they basically owe double what they have on hand.
Pretty much. It means they only possess roughly half the liquid assets required to cover their short-term liabilities. When you combine that with a $6.2 million annual operating cash burn, the financial pressure is undeniable.
Which brings us back to that $20 million capital raise option we discussed earlier. It's a lifeline for the company's survival, but it represents a massive structural risk for the individual investor.
It's the classic dilution trap inherent to microcap investing. If management executes that option to draw down the full $20.25 million, they will have to issue millions of brand new shares to those institutional backers.
Diluting the current pool.
Yeah. The overall value of the company might stabilize, but your individual slice of the pie will shrink drastically. Your equity gets diluted to fund their survival.
So you could be entirely right about the technology succeeding and still lose a significant portion of your investment due to share dilution.
Exactly.
And that financial risk is compounded by the regulatory realities. We celebrated the ADHD biomarker discovery, but we have to be brutally clear with you listening. That announcement is strictly research stage.
And a successful research press release is light years away from a commercial product you can legally sell to a hospital system.
Right.
The reality of navigating FDA approval pathways, whether it's a 510(k) clearance or a de novo pathway for a novel diagnostic, is punishing. To prove that their AI model is safe and effective, they must fund and execute large-scale, double-blind clinical trials.
And those trials require recruiting hundreds of patients, conducting the traditional subjective diagnoses, performing the AI scans, and proving a statistically significant correlation to the FDA reviewers.
That process could easily cost upwards of $10 million and take anywhere from 2 to 3 full years to complete.
Wow.
Yeah. And if the clinical trials fail to replicate the early research data, if the AI shows too many false positives in a broader population, the regulatory thesis collapses overnight, taking the stock price down with it.
So you're dealing with a ticking clock on the cash burn, racing against a notoriously slow and expensive federal regulatory agency. That is a heavy speculative risk profile.
It is speculative, but there is a vital structural difference here compared to a traditional biotech company testing a single drug.
Which is?
Because Firefly has built a universal foundation model of the brain, they are not entirely reliant on the ADHD trials succeeding. If the ADHD biomarker hits a regulatory wall, the underlying 191,000 scan database still holds immense value.
Oh, because the AI can look for other things.
Exactly. They can pivot the algorithm to search for biomarkers related to clinical depression, severe anxiety, or early onset Alzheimer's. Alternatively, they could simply abandon building their own diagnostics and pivot to a licensing model.
Selling access to their massive data platform directly to pharmaceutical giants.
Right. Big Pharma desperately needs better neurological data for their own drug development.
So the technology is a platform, not just a single-use product, giving them multiple shots on goal if the first trial fails. Let's pull all of these moving parts together into the definitive wealth-building playbook. We've mapped out the artificial intelligence moat, the explosive clinic growth, the brilliant quantitative money flow, and the undeniable microcap dilution risks. How should you actually structure a trade around this?
Synthesizing all of this data, the setup earns a conviction score of 7.5 out of 10. The operational momentum and the 33-fold growth in scan volumes are deeply compelling, but that upside is heavily anchored by the preclinical microcap risk profile.
So what's the time frame?
For your time horizon, you're looking at a 6 to 12-month swing trade. You are positioning yourself to capture the volatility leading into their upcoming clinical validation milestones, waiting for the broader market to fully digest the ADHD biomarker validation.
And discipline on the entry strategy is paramount here. I mean, buying into a stock immediately after a 126% daily surge is usually a recipe for disaster.
Never chase the vertical spike. The strategic entry point is to accumulate shares on any algorithmic dips below the $1.50 mark.
Why $1.50 specifically?
That $1.50 level is structurally vital because it matches the exact price of the March 8th institutional financing. It establishes a psychological floor where the smart money stepped in.
That makes total sense. And what about position sizing?
As for position sizing, you must keep this restricted to 2 to 3% of your total portfolio. The extreme daily volatility of this ticker will shake you out of your position if you are over-leveraged.
So treat it with the exact same sizing and risk parameters as an early-stage venture capital bet. What are the specific upside targets and the emergency exit parameters?
The initial upside target sits between $3.50 and $5 per share. That valuation gets unlocked if a company successfully secures an FDA breakthrough device designation or announces a strategic licensing partnership with a major pharmaceutical firm.
Okay, and the downside?
Capital preservation is your first priority. You must maintain a strict, non-negotiable stop loss at $1.
A hard stop at $1.
Yes.
If their clinic scan volumes begin to decelerate, if a clinical trial misses its primary endpoint, or if they fail to execute the remaining capital raise, the fundamental narrative is broken. If the price breaks $1, you exit the position immediately and move on.
Total discipline is the only way to survive trading microcaps. I want to leave you with a broader, more philosophical concept to ponder today, something that extends far beyond the immediate share price of this specific company. We spend time today breaking down how ADHD is currently diagnosed through highly subjective interviews, behavioral questionnaires, and human observation. But if artificial intelligence and massive foundation models can now reliably map, analyze, and diagnose the biological reality of the human brain with more objective accuracy than a trained neurologist's manual interpretation, well, what happens to the standard of care in psychiatry over the next decade? Are we literally standing at the precipice of the end of subjective mental health diagnoses? It's something to think about as this technology inevitably scales.